In this video, we will look at commonly used ratios. When you look at a company's financial statements, you see a lot of raw numbers. But to really understand the health of the business, we need to categorize these numbers into 5 key buckets. We look at profitability, return, leverage, liquidity, and efficiency. These are the tools that help us translate data into insights. Before we jump into the formulas, we need to understand the analyst's objective. Your goal is not just to calculate every ratio in the book. Instead, you should pick the ratios that match the specific nature of the company and your study objective. Also, you must look beyond the balance sheet. Often, the real story is in non-financial metrics like capacity utilization or occupancy rates. And remember the golden rule. Comparison must always be relational. You must only compare two numbers if they have a logical connection. Comparing unrelated numbers will give you zero insight. Let us start with the first pillar, which is profitability ratios. These metrics measure the profit of operations on a per rupee of sales basis. Think of it as a check on the business model's strength. If an industry has high competition and pricing pressure, you will naturally see lower profitability. However, if a company has a unique business or strong entry barriers, often called a moat, it will command higher profitability. The key metrics we watch here are the EBITDA margin, PAT margin, EBIT margin, and no PAT margins. The first major profitability metric is the EBITDA margin. This looks at profitability purely based on operations. We calculate it by taking earnings before interest, tax, depreciation and amortization, or EBITDA, and dividing it by net sales. This is a great tool because it excludes non-cash costs like depreciation and external factors like funding and tax. A higher margin here indicates greater operational efficiency. Let us look at a case study of Bharti Airtel. In the financial year 2018, their margin was 36.6%, but in the financial year 2019, it dropped to 32.2%. This is a significant drop of roughly 440 basis points year on year, indicating a decline in operational efficiency. Next, we have the PAT margin or profit after tax margin. This represents the residual profit available for shareholders after paying everyone else, including the government, lenders, and suppliers. The formula is simple. We take the profit after tax and divide it by net sales. An increasing trend here is a great sign. Let us check the numbers for Bharti Airtel again. With a profit after tax of 16,875 and net sales of 8,10,714, the margin for the financial year 2019 comes out to just 2.1%. While profitability tells us about margins on sales, it does not tell us about the productivity of the money we put in. For that, we use return ratios. These answer the question, what is the productivity of every rupee invested? We look at two main ratios. First is return on equity or ROE, which measures return for shareholders. Second is return on capital employed or ROCE, which measures return on total capital. A crucial calculation rule to remember here is that while sales are for a period, capital is measured at a specific date. So, always use the average net worth or assets by taking the opening plus closing balance and dividing by 2. Let us zoom in on return on equity or ROE. This is often considered the most important parameter for equity investors because it measures capital allocation efficiency. The formula is profit after tax divided by average net worth. Let us calculate this for Bharti Airtel. We take the opening net worth of 7,83,483 and the closing net worth of 8,49,486 to get an average net worth of 8,16,000. 16,485. Dividing the profit of 16,875 by this average gives us an ROE of 2.1%. Now, let us look at the return on capital employed or ROCE. This looks at the total capital, which includes both equity and debt. The formula is EBIT divided by average capital employed. For Bharti Airtel, the total capital jumped from roughly 18 lakhs 96,818 in 2018 to 21 lakhs 3,763 in 2019. Using the EBIT of 47,626 and dividing it by the average capital of roughly 20 lakhs, we get a ROCE of 2.38%. This shows how much return the company generates on every rupee of total funding. Moving on, we must assess the risk, which brings us to leverage ratios. This is a balancing act between operational funding and financial risk. High debt can fund operations and growth, but it creates a massive risk during economic downturns. Our objective here is to analyze the extent of this leverage and the company's capacity to service it. We primarily look at two ratios: the debt to equity ratio, which focuses on the balance sheet, and the interest coverage ratio, which focuses on the profit and loss statement. Let us examine the debt to equity ratio. The formula is total adjusted debt divided by net worth. Ideally, a conservative benchmark is a ratio of less than 1. However, let us look at the live data for Bharti Airtel for the financial year 2019. The total adjusted debt, which includes loans, bonds and deferred obligations, stood at 12 lakhs 87,036 with a net worth of 8 lakhs 49,480. The debt to equity ratio comes out to 1.52 times. This is higher than the conservative benchmark, indicating higher leverage. It is not enough to just know the debt level. We must know if the company can pay the interest. For this, we use the interest coverage ratio. The formula is EBIT divided by interest expense. A high ratio puts the company in a comfortable zone. However, if the ratio is less than 1 or negative, it means earnings are insufficient to pay interest. This is a major warning sign. A classic example is Kingfisher Airlines, which failed because it was consistently unable to service its debt obligations from its earnings. Next, we check if the company can survive the short term using liquidity ratios. The most common one is the current ratio, calculated as current assets divided by current liabilities. For Bharti Airtel in 2019, this ratio was 0.35. Usually, a number below 1 is bad. However, an analyst note here is important. A low ratio is acceptable if the company has high bargaining power, like in the telecom sector, where they operate with negative working capital. For a stricter test, we use the quick ratio, which removes inventory from the current assets, as inventory is not always easy to sell quickly. Finally, we look at efficiency ratios to see how well the business manages its operations. First, we have accounts receivable turnover. This is revenue divided by average accounts receivable. A high number is good because it means efficient collection. Conversely, a low number suggests the company is giving easy credit or facing recovery issues. Then we have accounts payable turnover, which is purchases divided by accounts payable. A low ratio here implies long credit periods. This could be a sign of bargaining power, or it could be a sign that the company lacks funds to pay suppliers. We also look at efficiency regarding assets and inventory. The asset turnover ratio is net sales divided by total assets. This tells us how many times the assets are churned to generate revenue. A higher ratio is always better. Then we have inventory turnover, calculated as sales divided by inventory. This shows how fast inventory is sold. A high ratio is typical for fast moving consumer goods or FMCG companies, while a low ratio is common for capital goods companies where products sit for longer. This helps us spot if capital is getting locked up unnecessarily.